Intercompany transfer of assets. In this learning objective, we're going to look at the upstream sale of depreciable equipment. We'll look at the equity method of accounting, and similar to the downstream transaction, we're going to start with X7. That is to facilitate the purchase of the equipment by the subsidiary in years prior and to depreciate it. But X7 will be basically our year 1, X8, year 2, and so forth and so on. Here's the information for the parent and the sub. Here's the separate income and the sub's net income. Here's the X8 information. And here's the information of importance, which is the equipment. Subsidiary sells the equipment to the parent for 105. The subsidiary originally purchased the equipment in X4 for 225. And that allows us to compute the rest. The X7 activity will include the net income and dividends, and we're going to focus on the special allocation items, which includes the deferred gain or loss, or unrealized gain or loss, and the depreciation. Here is the subsidiary's income allocation and the dividends. We can now address any unrealized gains or losses and depreciation that come about. Here's the information. The sub sells it for 105. Sub purchased it for 225 a few years ago, and we can look at that. So this is what the sub did when they originally purchased the equipment. Debit equipment, credit cash for 225. Credit. Depreciate the asset. Here's the formula. And we see that in years 4, 5, and 6, the subsidiary depreciated the asset for 22.5. The sub sells it for 105. Now, you may notice that these numbers look familiar, and they should. What I've done is on the equipment itself, I have left the numbers the same, so the cost and the accumulated depreciation numbers are the same as they were for the downstream transaction. What I have done different, though, is on the downstream transaction, we saw an example of a gain. On the upstream transaction, we're going to see an example of a loss. So you can apply the concepts for a gain or a loss on an upstream or a downstream transaction. So what we have here is the cost of 225, accumulated depreciation 67,500, and that results in a loss on the sale of 52,500. So the subsidiary would make the following entry to record the sale. We need to start thinking, is this loss stated correctly? And we're going to find out that the loss, it is stated correctly, but it needs to be deferred because the equipment has not been sold to some third party just yet. So we can now go back to the equity method of accounting and record any transactions related to the sale. We do see that there is a loss. We do see that since the deferral is there, the loss is overstated. So remember that on the subsidiary's records, they have a loss, or this is reducing their net income by 52,500. So what's going to happen is when the parent makes the equity method entries during the year, they're going to make the net income and the dividend entry. But you have to remember the income, or the net income from the sub, is understated by 52,500. So what we're going to have to do is come in, and since we know of this transaction, we're going to have to increase the income by the amount of the deferred loss. So we're going to debit investment, credit income from subsidiary, but what we're going to do, though, is we're going to increase it by 80%, or our ownership percentage, 80%. So 52.5 times 80% is 42,000, sorry. and that counteracts the loss that's in the net income sub. We must also address the depreciation side of things. The parent purchased the equipment for $105, so they're going to make the following entry: debit equipment, credit cash, $105. The parent will depreciate the asset, and they'll do it at the following amounts. They will take 105 minus 0 and divide it by the 10-year life minus any years that have already been used by the sub, which has been 3, X4, X5, and X6. And they come up with a depreciation amount of $15,000 per year. Now remember that both parties can be no better or worse off because of the transaction. So the depreciation between the parent and the sub differs. The parent's records show a value of $15,000. The subsidiary was depreciating it at $22,500. So in this example, because there's a loss, the parent is not taking enough depreciation. So they're under depreciating the asset. What we have to do is, on the consolidated records, we need to bring the depreciation to $22,500. So we're going to end up adding some depreciation, or increasing our depreciation expense, which is going to in turn lower net income. So this $7,500 is going to be a key number for us, and that is, we'll refer to this as the excess depreciation amount. We're not going to use the words under depreciated or over depreciated. We'll just refer to this commonly as excess depreciation, whether it's a negative or a positive number. So what we'll do in the current year under the equity method of accounting is we're going to reduce income from the sub by $7,500 times our ownership percentage. So remember, a debit is going to increase an expense which will lower net income. Remember, we haven't taken enough depreciation. So we're going to take $7,500 times our ownership percentage of 80%, and we're going to do it to the tune of $6,000. So if we recap everything, we've got the net income, the dividends, any deferred loss, and then the excess depreciation. This is a little clearer when we look at the reconciliation. And notice what we're doing. There's a loss there, so we're going to add that loss back to undo the effects of that. And then if you look at the parent's depreciation, there's $15,000. They should be, the total depreciation should be $22,500, and that reduction of $7,500 will bring us to where we need to be. The nice thing about this is all of the concepts from the downstream transaction and the upstream transaction are the same. The only difference between upstream and downstream in these learning objectives is on the upstream transaction, things get allocated out 80 to 20 or 90 to 10 between the parent and the NCI. On the downstream transaction, 100% of it goes to the parent. So if you can get one, it should be easily transferable and you can get the other. Here's our book value computations. And then we have our investment subsidiary reconciliation, and then our NCI reconciliation.